Good morning or good afternoon, wherever you're located. My name is Tosin Jack, and I'm the Commodity Intelligence Manager at Mintec. I'm delighted to welcome you to our webinar today, which is aimed at providing you with a market update and price outlook for selected food commodities for the second half of the year. I'll be moderating today's webinar, which will be presented by my colleagues, Ibi, Alana, Rutika, and Ramnik. Today, we'll be reviewing the price movements of the global sugar, grains, meat, and fruit and veg markets. And then we'll do a deep dive of the commodities within these categories that were significantly impacted by COVID-19 in the first half of the year. Beyond COVID-19, we'll also highlight factors to look out for in the following 6 months and provide a price outlook for this period. Before I hand over to the analyst, I would like to briefly tell us about what Mintec has been doing. So Mintec has been tracking, analyzing, and reporting on the impact of COVID-19 on commodity markets. And we've been able to use our data and platform to create category indices and bespoke dashboards to clearly see the commodities that have experienced significant price movements during this period. And this has basically informed our decision on commodities that we'll be presenting on today. I'll now pass on to Ibi, who will take us through the global sugar market.
Thank you very much, Tosin. Prior to the pandemic escalation, sugar enjoyed a 5-month bull run, which started in September 2019 and peaked in February this year. The London Commodities Exchange saw prices increase by 30% over this 5-month period to $413 per tonne, and prices at the New York Exchange had increased by 21% over this period to $324 a tonne. And at both exchanges, these were the highest prices seen in the last 2 years, and several key drivers behind those. Firstly, expectations of a tighter global market than we'd seen in the last few years, and production was actually expected to contract by 6 million tonnes year on year in the current crop year, the 2019-20 year, according to the USDA, particularly with India and Thailand, two very prominent producing regions, experiencing poor weather at the start of the season. At the same time, Brazil was expected to produce slightly less in the 2019-20 season, and the attractive returns on ethanol also meant that expectations were that Brazil would convert considerably more sugar to ethanol as opposed to sugar. So all these were leading to the expectations of a tight market, which led it to the peak that we saw in February. Now, in the 2 months ending late April, so this is once the pandemic effect had started kicking in, you saw the London futures price actually fall in 21% in those 2 months and to $326 per tonne, whereas the New York price fell by 31%, and this was to $224 a tonne. And the New York price was actually at the lowest levels seen since the end of 2007, which was due to various drivers associated with the coronavirus. Firstly, thin demand, obviously, from the food service sector, as well as lack of tourism, demand for confectionery and ice creams and this type of thing. Then had weak oil prices, which would obviously lead to lower costs, which to some degree offsets weak prices, but on the other hand, it can obviously mean that prices can lower. At the same time, you had a weakening Brazilian real, which is very important given that Brazil is one of the major suppliers. The real fell by 30% against the US dollar between January and April this year, which obviously made Brazilian exports far more competitive. And then we also had the weather improving in South Asia, as well as poor returns to ethanol production meant that more sugarcane was now being converted into sugar as opposed to ethanol. So all these led to the prices plummeting, as we saw that ended in that period in late May. However, there was a brief uptick in May that we have seen over the last few weeks, and this is due to the impetus with some of the lockdown restrictions easing in certain regions, and the demand impetus meant that the New York and London prices both showed double-digit percentage increases in the 3 or 4 weeks ending mid-May. So how do I see prices playing out for the second half of the year? I think firstly, it's important to caveat with the uncertainty that still surrounds the coronavirus pandemic and whether in fact the lockdown measures will continue to be eased, or in fact, for instance, a second wave may lead to those harsh measures being re-implemented. That being said, I do see prices average for the next 6 months at either flat or slightly below the levels we saw in the first half of the year. I think the short-term price impetus that we've seen in the second half of May is likely to subside as the truer fundamentals feed into the market. And I think the truer fundamentals is that the market is likely to be in a trade surplus this year as opposed to a contraction or a deficit that the USDA saw. I think Brazil, firstly, is looking to have a record production year this year, as well as Thailand and India also looking to have significantly better years than were initially predicted at the start of the season with the poor weather. At the same time, Brazil is likely to see more of the sugar cane converted into sugar, given the still quite low returns to ethanol. And then you've got sugar consumption that's likely to contract by a few million tons this year. Now, the USDA hadn't yet factored in the effects of coronavirus fully into this outlook, which is likely to be revised. So that being said, a trade surplus of a few million tons, 2 to 3 million tons, is increasingly likely, which will obviously weigh on prices. Risk factors mainly would be, I'd say, oil, given that even though prices are still moving upwards at the moment, the International Energy Administration actually expects that oil demand will be depressed for the next couple of years, which will obviously have impact on those currencies that are also pegged to the oil price, as well as the production costs and the competitiveness of certain import or export markets. So these are all the factors, including weather, that I expect will provide the biggest risk over the next 6 months. And now over to you, Tosin.
Thanks, Ibi. Something you talked about was the sugar versus ethanol in relation to the low demand for ethanol as a result of the pandemic. This is also something that has impacted the grains market. So Alana will now give us an update on the grains market with a focus on wheat.
Thank you, Tosin. Yes, the coronavirus outbreak was one of the main drivers shaping the grains market during the first half of the year. In our global grains index, we can see that prices fell rapidly from the beginning of the year until March. This was led by increased uncertainty, which pressured most grains prices. Although the main driver of the index here was maize, that at the time prices nosedived to decade low as a result of low demand from the ethanol industry as a result of restrictive measures. This was followed with a spike in prices in April. More consumers were searching for non-perishable goods, which drove wheat and rice prices up in particular. The biggest surge was seen for wheat, however, and this is the reason I'll be focusing on this market. So looking at the wheat market, we can see on the graph that wheat prices on the Chicago Board of Trade fell rapidly for most of the first quarter. As previously mentioned, this was mainly due to the spread of COVID-19 and increased uncertainty in the market, which led to a rising concerns over possible reduction in global consumption. However, wheat prices surged from the end of March into April following announcements of lockdown measures across the world and the World Health Organization declaring coronavirus a pandemic. This led to a lot of panic buying and stockpiling of unperishable products, especially for wheat byproducts such as pasta and flour, as more people were confined at home and most of them will find doing a lot of home baking. This increase in price was further exacerbated by protective measures put in place in the Black Sea region. Both Ukraine and Russia implemented export restrictions. Russia, for instance, imposed a 7 million tons quota from April to July, which rose market concerns over potential reduced supply availability. However, a report released in May by the USDA actually forecast a record production and ending stocks for the 2020-21 marketing year, and this weighed heavily on prices on global on US wheat prices, indicating a bearish outlook going forward. So looking ahead, we do expect prices to be bearish. we expect COVID-19 to continue to weigh down on prices, even though lockdown measures are being eased. There are still a lot of uncertainty and instability in the market. Prices are expected to recover slightly due to high global demand forecast for this marketing year. However, a projected record world wheat production is likely to curb some of this upward pressure in prices. Also, the US domestic consumption of wheat is expected to fall this season with anticipated record maize output, so encouraging buyers to shift from wheat feed to maize feed due to price competitiveness. We do expect as well a high competition in H2, especially from Russia and Australia. So Russia is forecast to overtake the EU again in 2020-21 as the largest wheat exporter. And meanwhile, after suffering for a few years with extreme droughts, Australian wheat output is anticipated to soar on the back of favorable weather conditions. And if these numbers are realized, Australian wheat exports could double, meaning that they could actually recover some of the market, the export market that they lost in the previous years due to limited availability. But in addition, most suppliers' native currency is depreciating against the dollar, which is the case for major suppliers such as Argentina, Russia, and Australia. This is likely to make the wheat even more attractive in the global market. So overall, bringing all together, we expect a bearish trend for the second half of the year, with the average price likely to be equal or lower than the first half. However, something to keep an eye on is the unexpected weather events could compromise the healthiness of the southern hemisphere crops and the overall volumes, and also any developments in the trade negotiations between US and China can quickly weigh on market sentiment and lead to rapid change in prices.
Thank you, Alana. You mentioned lower grain prices, which of course is traditionally good news for the livestock industry in terms of lower feed costs. But it's been a lot more than that for the global meat market due to various factors, which Rutika will now take us through, and with a deep dive into the US pork market.
Thank you so much, Tosin. So the coronavirus outbreak impacted global meat market significantly. As you can see on the slide, Mintec's Global Meat Index indicated a bearish trend in the market since the beginning of 2020, with some uptick seen recently. Markets such as New Zealand lamb, US pork, EU chicken, and EU pork drove the index as reduced exports and subdued demand resulted in diminishing prices. Exports of New Zealand lamb to the EU and China and EU chicken to Asia and other Eastern European countries was mainly disrupted due to the pandemic. Also, reduced demand from the food service sector due to the lockdown weighed on the EU lamb, EU pork, and US beef market to a larger extent, driving down the prices even further. In addition, African swine fever contracted EU pork exports, further adding downward pressure to the EU pork prices. Besides, depreciating peso led to a decrease in meat demand from Mexico, which is US top meat export destination. Whereas depreciating real boosted Brazilian meat exports. Thus, Brazilian chicken exports were high in May and reached highest volume shipped since July 2018. So we can say that the Brazilian meat market has been less impacted by the pandemic. Furthermore, some of the markets such as China and the EU have reopened, which has strengthened demand and thus the index recently. However, moving ahead, I would be diving into the US pork market, which significantly influenced the meat index in half 1 2020 and is expected to be a crucial driver for half 2 2020. So, US pork half one average price in 2020 plummeted 26% year on year and 15% compared to half to 2019, as you can see on the slide, which was a result of an increase in quarter one US pork output, which increased by 8% year on year. Q2 output is also estimated to increase, but at a slower rate due to the reduced capacity utilization with distancing measures implemented because of COVID-19. Secondly, due to the diminishing demand from the food service sector after the announcement of the lockdown, prices plummeted 48% between 25th March and 10th June as seen on the Mintec Analytics graph. However, there were some other factors which limited the further price drop. Um, as discussions of the US-China trade deal began on a positive note, pork shipments to China increased 477% year on year in quarter one 2020, despite some disruptions. Also, surging exports to Japan and temporary factory closures to avoid the infections of the employees curbed the further price decreases. So looking into the outlook for the remainder of the year, US pork prices are expected to fall 0 to 3% compared to the half one, and which are mainly driven by high production due to increase in slaughter rates and sluggish domestic demand. However, prices are likely to recover from the current lows with an increase in shipments to Japan and China. Besides all the above factors, there is one more factor which we need to consider is the US-China trade tensions, which are likely to aggravate as China approved a security law in Hong Kong restricting liberties in the financial hub. So, uncertainties around the progression of the trade deal is likely to limit US pork exports to China in the compared to the H1 in H2. However, a gradual increase in exports is still expected. Though demand recovery from the food service sector is predicted to add some upward pressure to the average price, economic downturn due to COVID-19 has affected the spending capacity of the consumers, which is one of the most important factor we need to consider and is likely to keep a lid on prices in half to 2020.
Thanks, Rutika. It's been great to hear about meat. As expected, we've seen a rise in the health and wellness trend, which has impacted the fruit and veg markets, where we've also seen a change in trade dynamics. So Ramnik will give us an update on this market.
Thank you, Tosin. My focus today will be on the global fruit and vegetable category, and in particular the Indian onion market. The Mintec Fruit and Vegetable Index has mainly moved upwards since the outbreak of COVID-19. The index rose with increasing demand, retail demand, due to fears of food shortages, and as a result, there was a lot of panic buying. In addition, since the lockdown, the dynamics behind meals eaten at home have significantly changed. Consumers across the globe are eating healthier foods, which are high in nutrients. This, in turn, has led to above average retail demand, and therefore higher prices. The easing of lockdown restrictions in recent times has led to a significant reduction in retail demand. This has led the fruit and vegetable index to trend downwards. The Indian onion price has been a big contributor to the downward trend, and in this webinar I will be focusing mainly on the Indian onion market. Okay, so to begin with, the average price of Indian onions during the first half of 2020 was 26,480 Indian rupees per metric ton. Prices ranged from as low as 12,000 Indian rupees per metric ton to peaks of 80,000. Prices of Indian onions in this period were largely impacted by the Indian export ban. India banned international onion sales in October to curb domestic prices. As you can see from the graph on the left-hand side on the slide, prices had risen sharply since July 2019 due to excessive monsoon rains and floods negatively impacting the 2018-2019 crop. In order to protect the interests of consumers, the government intervened just to ensure that domestic requirements were fulfilled. And as a result, all consumers within India were demand was met. Rising Indian production for the current year has been a bearish price mover during the first half of 2020. Indian output is expected to be higher due to favourable weather conditions, and production is estimated to rise by 7% year on year to 24.45 million tonnes. The export ban coupled with the expectation of higher harvest, has led the onion prices to decline sharply. So in order to stabilise the market and protect the interests of farmers, on the 15th of March, the Indian government lifted the export ban. The change in policy was expected to increase onion export demand and help farmers and businesses benefit from the higher prices in Asia. However, the outbreak of COVID-19 put a halt on onion exports, and as a result, the policy was largely ineffective. The coronavirus pandemic has impacted various functions of the Indian onion market, from both consumption to auctions. There has been a decline in domestic demand due to the closure of roadside eateries and food service outlets. Furthermore, lockdown restrictions across most of India have led to a drop in international demand for the bulb. Domestically, the Indian onion market has been oversupplied, with onions usually destined for foreign markets being consumed by the local customers and consumers. So due to its impact on demand, COVID-19 has been a bearish price driver, and with transportation and restrictions to auction times, farmers have been panicking to sell their produce. In order to protect the interests and the livelihood of farmers, the government has intervened to provide alternative trade routes. An example is the first cross-country rail service between India and Bangladesh. In addition, the government has recently decided to give a 50% subsidy for transportation, which I will discuss further in the next slide. In this slide, I will now discuss the price outlook for Indian onions over the next 6 months. Indian onion markets are expected to rise from the current levels, but will remain below the H1 average. The Indian onion price will be higher than current levels on the back of increasing domestic demand due to the easing of lockdown restrictions. We've seen an uptick in roadside eateries and food service demand as these institutions have started to open up across India. In addition, export demand from foreign markets is likely to rise with the reopening of other Asian economies. So onion produced for foreign markets are expected to reach the destination with the removal of the export ban, reopening of ports, and reopening of restaurant trades across Asia. Buyers such as Sri Lanka and Bangladesh, who rely heavily on Indian onions, are currently waiting for Indian onion supplies. In addition, the transportation subsidy initiated by the Indian Food Processing Minister, as mentioned in the previous slide, is likely to halt the bearish trend in the current Indian onion market. The government has issued guidelines to give a 50% subsidy in a fixed time frame for storing and transporting fruit and vegetables to prevent post-harvest losses and panic selling by farmers. So just a little bit about how the subsidy works. The subsidy will be distributed if the price in notified production clusters falls below the average of the preceding 3 years, or if it falls more than 15% from last year's price at the time of harvest. The subsidy is expected to ensure farmers and businesses get fair remuneration for their produce and avoid a situation where they panic sell. So overall, the policy is expected to be a bullish price driver in the Indian onion market. It will provide producers with a new market, as the ministry will provide a subsidy for transporting from surplus production cluster areas to consumption centres, or hiring of appropriate storage facilities for a maximum period of 3 months. Over to you, Tosin.
So to bring it all together, we've heard that COVID-19 has impacted all the commodities in various ways, and a common theme is the considerable loss in demand from the food service industry. Also, we're beginning to see some recovery in prices due to lockdown restrictions being eased and the reopening of economies, but there's still a high level of uncertainty, particularly around how quickly economies recover. So this makes it important to keep an eye on macroeconomic factors such as government support. What are the things in place to ease supply chain challenges? There's also currency exchange rates, which we heard during the presentation. They determine export competitiveness and highlight buying opportunities. Lastly, as the food industry continues to learn lessons and develop coping strategies to various risks and uncertainties, market fundamentals will remain crucial. So it's important to stay ahead of market trends and dynamics by staying informed. That brings us to the end of today's webinar. Thank you very much for joining us. If you have any questions about what we've presented on today, or if you want to know more about our platform, our data and insights that we generate from there, please feel free to contact us through any of the channels below on the screen. Thank you. Have a good day.